Hey everyone, this is Michael Bengiat. This is the Market Trend Advisory Weekend Report for May 14th, 2022. As usual, before we start, here's our disclaimer. Please take a moment to pause the video and read through it. Well, let's go ahead and get straight into the market. There's really no change on our summary here for the last week. Nasdaq's in a bear market. S&P has narrowly avoided going into a bear market, but we've had no exposure, no positions on for quite some time. And then with our investing strategies, again, we've been out for a while. We got, remember, these are leveraged strategies. So we're down a little bit more than we'd like, but considering the market environment, we're actually matching the non-leveraged versions, the QQQ and the SPY. So that's actually pretty good. And if and when, I'll say if or when, the market improves, we'll actually probably come back pretty quickly. But that's the big question, is what's going to happen going forward, and we're going to talk about that more in a little bit. So here is the NASDAQ currently. Sentiment and technicals got very, very bearish after this kind of a waterfall decline. And so we, Thursday, had a day where the bulls kind of put up said no more for now. And we had a big rally yesterday, which was Friday. Let's go to the S&P. Same thing, maybe not as strong, but we still sort of are market's trying to find a bottom here. I think because of all the very negative sentiment and other indicators we're getting, the market's that's probably it for right now. Let's go to monthly charts now. So this is the NASDAQ. And again, over here you can see this channel that we had going back in the 90s into the final blow-off top that we had in 2000, and then the subsequent breakdown over 80% in the NASDAQ. And then, of course, we've shown this chart a bunch of times in this channel. We broke above it more than a year ago. And again, just kind of showing the overextension in the markets and what happens afterwards. And so we broke above here, stayed above it, and now we've broken down. And as we mentioned in the last couple of weeks, that we suspected that would get some support right at the 40-month, which is this green line. And we actually went down slightly below it, I think on Thursday, but we came back from that. If you look at the chart, it looks like we got support right at it. But this is a log chart, so the numbers are compressed. But we did slightly break it, but it looks here like we got support and what we expected. So, and you can see here, going back to 2000, we came down, similar kind of, this is even more dramatic on the crash, got support. We actually closed right at that 40-month. And then the next week we went above it, this is a monthly chart. We went above it and then we broke below it. You can see we had a little bit of a fight going on here. The following month, I'm so used to looking at weekly charts that I forget sometimes that, okay, this is a monthly chart. And here we had another month where it just came roaring back, closed above it, and then finally we had the capitulation, broke down. The markets don't go down without a fight. You still have that bottom fishing mentality of which we are seeing just in spades right now. And unfortunately, that kind of is a clue that we're probably not at the bottom. It's only when you really get down here after extended, this was almost 2 years of a decline where that just all gets wiped out. And that really just sets the stage for a really nice bottom that's sustainable. Let's go ahead and look at the S&P. Same thing, we didn't have as much of a break above this channel. Back in 2000, we just kind of hugged it, never even got up to it in the final bit, and then we collapsed. So here we got above, again, showing that all that stimulus and the trillions of dollars that was pumped in the system really dislocated the markets. Here we've come down, it looks like to I think that's the 20-month, and got support, but we haven't even come down to the 40-month. I suspect that we'll probably be coming down there and testing that at some point. So this coming back to the NASDAQ. So here's that percentage of NASDAQ stocks above the 200-day moving average. And this went under 10%, I think, on Thursday. I mean, that's really showing that 90% of stocks were below the 200 days. So that's in line with what we saw. If you come back over here, I think maybe we might have even been that amount down here. So it could be because of the internet, everything is moving so quickly that this has gotten compressed. But it's hard to tell. But that was this, and so the technicals really got pretty bad just on that. If we look at it more in a bigger picture here, this is from our bigger database. You can see the 52-week highs and lows. I mean, we got really down to Thursday was 1,668 lows, only 9 highs, and you can see the ratio was that's about as low as it can go. And we had a number of days here, and you can see just for a long time though, going into this, we had more 52-week lows than highs. So this is kind of almost like a washout. Excuse me. Just over here, this is something we sometimes point out. This is the number of stocks that have just broken out and stayed above the and fallen below the breakout points and stopped you out with a down 5 to 7%. And you can even see this number has just been decreasing, and down volume's been swamping up volume, especially on this day, which was probably Monday. So we're all getting kind of signs of this is maybe enough for right now. Here's sentiment. You can see that the CNN fear greed went down to 6. We've been hitting panic levels. We kind of went from extreme fear to panic. The AAII survey, we've gotten very bearish. This is of course contrary. We've had more bears than bulls for some time, and usually when these cross, if we had a chart, which I don't have here, you'd see that they're actually crossed, and that's been a good indicator of a bottom of sorts. Not the bottom, but we're getting to that point though where we're getting close in terms of both the sentiment and the technicals. But I wanted to point out a few things too in the next couple slides. So let's just come back to the S&P first, and the S&P, which if you're kind of a conspiracy theorist, you wonder, okay, what are the powers that be doing? Because the S&P almost got to a bear market, that 20% down from a peak, and the hit S&P, and then before we rallied in the last couple of days, and the S&P has a history of not quite hitting that 20% bear market level. So you can argue, well, the powers that be say, hey, we can't have these headlines of the market being in a bear market. That just makes people depressed. They're already worried about money at this point, and they've seen their portfolios decline. So anyways, the NASDAQ it's not as much of a headline number as you usually see the Dow or the S&P. The Dow really is only 30 stocks, so it's not like it has a lot of bearing on but it's just been that standard index for over 100 years. So it's used. And the S&P, though, of course, is more of the whole market. So interesting that, again, didn't quite get there. And the S&P has actually dropped 19% 15 times since 1957. And if you look at it closely, the 5 of those were actual bottoms where we just came straight up off of that and had nice years after that. 5 were followed by double-digit declines with an average drop of 32. Those, of course, were the bigger bear markets that we've had infrequently. And then 8 were associated with recessions. And interesting, though, we never even got down below 20%, even in a recession. So looking at all these things, most of these bottoms have come with the Fed backstopping the market. And that's really, if you go back, many, many decades, it's really about the Fed backstopping the market. That's really what they've been doing. And there's that, what they call the Fed put, which has been the Fed will always come to the rescue of the market whenever there's trouble. And so here's just a few examples. In 2011, the U.S. came close to defaulting on its debt, and there were troubles in Europe. The Fed, I don't remember if they were actually in a tightening mode, but they basically opened the spigots again. In 2018, we entered another bear market, and with the collapse of long-term capital management, that was sort of seen at the time that it was, potentially could derail the whole financial market, and they opened the spigots again. So these days, when we're looking at things in the trillions and hundreds of billions, I think they were just down, in the single digit billions or something like that, which seems like nothing today. But that's how much the market has changed. And then, of course, we have in 2020, we have the COVID shutdown, so where they really had to open the spigots up. So the big difference now is, and likely the Fed can stop its tightening cycle now because they just started it. And with interest rates have gone so far down to zero and negative interest rates, they were sort of stuck there. So that's a big problem going forward for the market. Here, I just want to go through a few other things too, and we're going to come back to here about the similarities with the dot-com bust. So, has the market, bottomed? I've seen all sorts of articles popping up on different sources. It's unlikely that we've seen the bottom. Just kind of anecdotally looking at what's going on. We had on Thursday and Friday the meme stocks back in action again. And I think it was GameStop. It was halted several times during the day because of the volatility and the big moves. And one of the things that you'll just notice over time is that you don't get a true bottom after a waterfall decline like we've been seeing when it just gets frothy right off immediately. And really the big moves yesterday and Thursday were all the most beaten down stocks. And we talked about that in the notes on Friday. I don't have a chart here, but I've been actually screenshotting just some of my watch list. And, we had like 4 or 5 days down where a lot of these stocks were down, 10, 20%. And then, of course, we had a lot that went up over 20% just on Friday. So it's just a lot of bottom fishing going on here. Volume came in low, which was not a good sign. Doesn't show that institutions are stepping up. So it's unlikely that we've seen the bottom, but you never know because it's the stock market. The Fed might just try to come out with some statement that says that they're supporting the market without actually doing anything in terms of what they're going to change going forward. But so that's a possibility. But what we are getting is a lot of increasing similarity between today and the 2000 and 2002 bear market. Again, as we talked about, one of the key things is that the Fed was on a tightening path, which was back then, and it is now. And second, the market was in a bubble. You can actually go back to my blog. If you just go to lifetimeinvestor.com/blog, you'll find that ongoing bubble article, which I started, I think, in February of 2021. And basically, the bubble's burst at this point. We're seeing the Nasdaq's down almost 30%. We're seeing all those things that happened. In hindsight, it was a bubble, however you want to take it. And we had many indicators of overvaluation, crazy behavior, and we're still getting it. I mean, the fact that meme stocks are back, it just shows that there's too many people still wanting to buy the dip. So back then, the interest rates were much higher, so they had a little bit more room, but they didn't tighten. They didn't cut as fast as they probably should have. Today, they seem to be much more trigger happy. But today the Fed just can't cut like they did. They can't back down and open up the monetary spigots because of all the inflation and other things going on. That's what's caused the latest massive bubble in what's happening in not just the stock market but in a lot of the markets. So that Fed put, that perceived insurance policy, the Fed's going to come to the rescue whenever Wall Street has problems, it's probably not a tool they can use now. And that's what the markets have been relying on, I think, since the 80s or the early 90s. So that is a big problem for the market going forward. And then another thing we're also seeing just finally is we're getting some other worldwide market dislocations. We have, of course, the crypto breakdown. We got, I think I wrote about it on Friday, on some of these so-called stable coins. I'll put them in quote, unquote, have turned out not to be very stable. And they broke their link with the dollar. One went to zero, though I think I just read something that it's come rocketing back because they decided to change the algorithm, how it's calculated. I mean, again, this is extremely speculative instruments, not any kind of store of value. How can you have a store of value in anything that's going to fluctuate that much, including Bitcoin? It doesn't make any sense, and a lot of that's in the bubble too. So, and then of course we just had something I just saw that we saw Hong Kong needed to defend its currency peg to the US dollar. And then the final thing I have here is just the question marks, is that there's probably a lot more things out there that are trying to get paved over and hidden behind the bookshelf or whatever that we just don't know about. Because this much dislocation, this many people in leveraged markets, especially in crypto, when you're having to have bailouts behind the scenes, we don't know what's going on. This is what happened in the financial crisis. It first came out that, it's just a little bit of problem in the mortgage market. And then eventually came out, that all these very high leverage derivatives that really were the core of the problem, and they were leveraged up to the gills. And I expect, because we were in a bubble, there are a lot of parties that really leveraged up and are starting to have to unwind. Now, whether or not these will turn into some market dislocating force, we don't know, but it's very likely that there's something else big coming down the pike. Hopefully not, but it wouldn't be uncommon or unlikely that that's going to happen. So all in all, just to wrap it up, we may have seen a bottom. We could go into a so-called confirmed uptrend. That would be if we get on after day 4. We're on day 2 of our rally. So as soon as Tuesday, if we get a high volume day and at least a certain percentage up, then we could enter a confirmed uptrend. Now, we're way below the moving averages. Let me just really quickly go back to the NASDAQ. So we're not even at the 10-day moving average, which is this pink line. So a rally that starts when you're this far below key moving averages, and also when they're all curling over in downtrends. If we were looking, we talked about it a few weeks ago, or last week maybe, about the stages. Well, this is a stage 4 downtrend. And these rallies can start, of course, it could go screaming up like we saw in 2000, but it had the Fed behind it, cutting interest rates and just basically giving money away. And so for this to really take off would be highly unusual. The Fed would probably have to back off of its thing, or some other super bullish, news comes out. But we could, even with that said, in bear markets, you can have very powerful, rallies. So we could even come screaming past the 21-day, which is this green line, and even up to the 50. It would be highly unlikely to go all the way up to the black line, which is the 200-day. But, we could just get another rip-roaring rally that just very convincing and pulls people back in. We've seen it in all bear markets, especially in 2000. There were some of those bear market rallies were, like 30, 40%. So anyways, that's what we're going to be watching for. I would say at this point, we're going to treat any rally sort of as a bear market rally. It's not to be pulled in and suckered in. It's unlikely it will turn into a new bull market has just started. But anything can happen. But I think we're going to sort of be skeptical about anything that occurs over here. So that's about it for this week. We'll be back next week with more excitement. Markets are never boring, and these last few weeks have been maybe not exciting in a good way, especially if you've been in the market. But following our system, you should be long gone and not being hurt by these declines, and really just in cash and ready for the next uptrend whenever that happens. Okay, thanks. Bye-bye.